CNBC-TV18, embarking on a quarter century of excellence.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning. What a week it has been, a roller coaster one. Actually, it's not been a roller coaster. It's been a one-way upward kind of ride, if you're using sort of game park analogies. I'm Prashant. With me, my colleagues Sonia and Nigel. Hi, morning.
Hi, good morning. It's Friday and there are no complaints really, right? Traders, investors have all had a solid month so far. And I think they're just going home with bags of money. That's the only way to put it. That's the only way to put it, right? And I hope the going is good.
I have a literal image of people who are...
But it's a good time as well if they're going home with money, because it's beginning to look a lot like Christmas, right? And I think the weekends also, I think all of us would have some plans. So the week has been very busy.
Yeah.
Gear up towards the end of Friday and say the kids at this party you need to go for, you need to show Santa, you need to write your letter. So the weekends are even more busy. So it's a fantastic time, I would
So good
say.
that your wallets are full so that you can go and spend them across.
Mine, not mine, but I have to spend
Traders
anyways.
and investors.
All right, well, let's just, as always, kick it off with a quick rundown of what you need to know as we begin another trading session then. You've got yesterday, for the first time after this week started, that we had a bit of a pause which came through. Otherwise, I mean, we were getting used to double centuries, triple centuries, more than that. Yesterday was a pause. So the market actually, on the Nifty, posted a negative daily close, but it was not a very convincing one. Right, it was just about a 0.17% kind of cut, nothing deep. The hourly averages did not break even once during the course of the day. But the backdrop is that we did get a bit of a negative technical pattern, an evening star formation, if you must go into details, etc. So we'll need to see if this is, this gets negated immediately, or perhaps there is some follow through. Institutional numbers on the cash side were very, very muted yesterday. And on the derivative side, FIs are now long 31,000 contracts in index futures. I mean, it's interesting. Last Friday, as we came into the week, we ended with about 50,000 contracts net short on FIIs. And I think by the time we end this week, I think you'll be that much long on the other side. And that's been, the sharp, swift 4% move that we've seen on the indices. Overnight, what happened? You had markets which were up. NASDAQ ended about 1.3% higher. The big mover, of course, was Google, which went up about 5% or so. In terms of macro data, the 10-year added about 4 basis points. The dollar index came off about 0.5% or so. So nothing really to take away. And I've been saying this for the last couple of days. In terms of, the yield, it's been largely lower. We're at about 4.1 compared to 5%, not very far back. But in terms of day-to-day kind of takeaways, there's not been very much. You had the initial jobless claims data which came through that rose, but very modestly. Later today, around the U.S. market opening time, we get the monthly data, the jobs data for the U.S., the November number. And that is the big one which markets will wait for. The kind of sentiment out there is that it will be a very, very weakish number. So we'll see if that is indeed the case, or we can get a surprise. Just one more thing before I kind of come back to the levels here. There's something happening in Japan. You got some very large moves coming through, right? I mean, same time yesterday we were talking about that 4% drop in oil prices. This morning, it's Japanese bond yields and the currency. So bond yields, the long end basically went up about 10 basis points. It's the biggest rise since December of 2022. And you got the JPY, which sharply rose, which means that the dollar JPY, the currency cross, fell 2%, is the largest move since basically the beginning of this particular year. What is the trigger? You basically had a very, very weak auction for the 30-year bond, which the government was sort of putting out, the Bank of Japan was auctioning. And you also had comments from Bank of Japan officials saying that they want policy normalization. Remember, across major markets, Japan is the only country where rates are still at 0%. It's not moved. It's not budged. Others have gone up 500 basis points, and now we're starting a rate cutting cycle, hopefully. Japan is at 0%. So it'll be very interesting to see if, this one also, when other rate cuts are looming elsewhere, Japan actually starts to increase rates. It's important what they do, essentially, because the JPY is a very cheap currency. It's used as a funding mechanism Berkshire Hathaway, for example, recently issued yen-denominated bonds to raise money. So there are implications in that sense. Let me just quickly circle back to the levels here then. As I said, we got a negative close. The recent high on the Nifty is 20,961. That's the first level on the upside, which the market will, which you need to watch out for. If you are able to take that out in a flourish, then you're basically looking at much higher levels. But that is the first marker on the upside. Very near-term supports, we've been using hourly averages for this. Comes in at 20,887. They've moved up a little bit. And 20,650. It's the 20 and the 40 hourly averages, which, yesterday, even though the market was down, never broke. We came close to it, but did not break. And if you're able to take out the recent high, as I said, 21,100 is the level, which kind of we put out at the start of the week as well, Monday and Tuesday. So that still remains the level on the upside. Bank Nifty closed absolutely flat in trade yesterday. So watch if yesterday's low, which is 46,507, gets broken. If that does get broken, then the hourly averages come in at 46,151. That's the 40 exponential hourly average, which should act as a bit of a support. I'm using very near-term levels because of the moves that we have had. Otherwise, the longer daily averages are very far away. For the Nifty Bank, the 47,260, which is the recent high, should act as a bit of a resistance, basically the upside level to take out, and then we march higher there. If that happens, 47,700 is still pending. The Nifty did it, but the Bank Nifty did not. It had 2 days of very slow trade. So we'll see what happens. The GIFT Nifty should come up on your screen, and I think we'll pick up the action as the day goes on. 40 points higher is what the GIFT Nifty is showing. The big one also, of course, is the RBI, right, Sonia?
Absolutely. And, generally on event day, on RBI policy day, the market just waits for the outcome, right, and then takes the call. So it wouldn't hurt anyone to just wait for what the RBI policy has to say. There is, of course, no move on rates expected this time around. So this is going to be the 5th time when the RBI keeps the interest rates steady. Remember, there has been some inflation some relief on the inflation front. So that's another reason why there is a pause expected this time around as well. But there are some other announcements that the street could watch out for, whether it's increasing the risk weights or even selling bonds in the open market. So perhaps some of these things is, what the market is looking out for. The commentary is also crucial. There is no change in stance expected, but any indication of a change in stance is something that the street will watch out for very closely. Remember, inflation is cooling off, and the expectation is that the rate cuts could come in from the second half of the fiscal year. So any indication on that will, of course, be a big positive trigger for the market, but the market is not expecting that at the moment. The US markets were also mildly in the green. The November jobs report is awaited, as Prashant was also mentioning. So that's the other big trigger. But for our own markets, the Nifty has been consolidating around the 21,000 mark with a positive bias. So yes, the GIFT Nifty for now is suggesting that it's going to be absolutely flat opening. Perhaps wait and watch, as we move into the RBI policy. Foreign and domestic investors sold in the cash markets. There's been a big rally up until now. So let's just chart the path, right? The Nifty is up almost 700 points in just 5 trading sessions. And the Bank Nifty rally is something that the street is watching out for very closely. If this market rally has to continue, then the Bank Nifty has to continue to participate. Remember, the Nifty Bank is up 7.2% in the last 1 month alone. So I'm watching out for that heavyweight to continue to move ahead. But what else are you looking at?
Well, Sonia, various reasons why the markets needed to pause yesterday. Right? 7 straight sessions we were winning. We had last 2 sessions where you had the Nifty weekly expiry, the Nifty Bank weekly expiry as well that played out. Flows seem to be on the sidelines, ahead of the big event. And, also you have 2 big cues today. One, the domestic front, the RBI. Second is on the global front where you get the US jobs report. And data points coming in this week itself indicate that maybe there are signs that the jobs market is cooling off. So you'll want the non-farm payrolls data to look a little bit softer than what's being expected. Yet again, yesterday, we had long positions that were added. More than 5,000 long contracts. Short positioning that was added close to around 3,000 contracts. Takes the long positioning to around 57%. And if we pull up a chart, after very, very long, I've seen, in the entire week, we have seen longs that have got added. Because at the start of the week, we were negative, it was net short to the tune of close to around 50,000 contracts. And just take a look at it. On a day-to-day basis, you have more longs that are added in comparison to the shorts. Now, in fact, the long positioning is added on 32,000 contracts. two strikes were active. 20,900 put and 21,000 call. Both of them fair bit of open interest premium, roughly around 80 to around 110 rupees or thereabouts, which brings us to the levels. I'll tell you what, it's a 400-point range that I'm looking at. Last two sessions, we went to 20,800 and we bounced off those levels. In terms of a stop loss, I think it's at around 20,750. So the downside, maybe it's limited to around 100, 120 points from here. But on the upside, that 21,050 odd, that should be a bit of a resistance zone. Key factors to track, expect the markets to consolidate a little bit ahead of that event. If there is no hint of any kind of hawkishness, we don't want the RBI governor to sound very, very dovish, but no hint of hawkishness, markets will take it with both hands and will resume the uptrend. And institutional flows need to be tracked. It appears for the last couple of days, they are waiting by, let this event get out of the way, and then we could see resumption of flows. And the FIs, we know, they are, they've reduced positioning and they've been quite underweight the Indian markets. So you'll want to see the return of flows out there. For starters, I think the gift inflow is indicating a bit of a positive start. So let's see how that goes. The RBI, governor, that's going to be the big cue. And from there, I think we resume the up move.
Guys, I just realized it's less than 20 days left for Christmas, right? So, we just keep talking about the here and the now, but its festivities have begun and it's the end of the year. A whole year has passed by. So, all of us should be in high spirits.
400 hours and I'm done for the year. 400 hours, so I can't wait for that. 20 days and all.
Big Christmas plans this year.
Absolutely. 2 more Fridays and I'm off for the race.
I thought you were going to pick up on Sonia's high spirits. Kind of.
Yeah, I know.
Navin, who's the naughtier one?
Yeah.
I'm just footing the bill, but the bigger party animal is there.
But who is to say you can't start early in the morning, right? I mean,
the teetotalers.
The teetotalers talking, all right. But we're all in high spirits here in the studio. But let's kickstart the show, actually. Lots to talk about as we get into the last trading day of the week. On the equities front, Chris Wood of Jefferies says that India's moment has been only furthered by the result of the recent state elections, which came in better than expected for the BJP. That prompts greed and fear to adjust the Asia-Pacific ex-Japan relative return portfolio to maintain the overweight call on India and neutral on China. Accordingly, the weighting on India will be increased by 1 percentage point, while the weighting on China will be reduced by 1 percentage point.
All right, well, let's get you some money market views now. This is coming in the rupee. Lakshmanan V of Federal Bank says that the Indian rupee remained relatively stable this week ahead of some key economic events like RBI MPC and US employment data. Crude at 5-month lows along with the 10-year US Treasury yield at 3-month lows. Along with robust inflows in equities may support the rupee in the coming days. He expects the rupee to trade between 83.2 to 83.48 to the dollar for the next few trading sessions.
And on the bonds, Lakshmanan says that the bond markets have traded in a narrow range with a positive bias, broadly tracking the fall in crude and the US Treasuries, which have fallen 90 basis points since October end. Economic data from the US and dovish comments by the Fed officials have increased market expectations of a rate cut by the US Fed earlier than expected. The Indian benchmark 10-year yield should trade in the 7.15 to 7.3% range in the coming sessions, with the status quo expected from the RBI in today's policy.
Well, we've got a lot of stock-specific action that we're tracking for you. For the time being, we'll just run you through the list. We're looking at Zomato, IRB Infra, Jindal SAW, Ircon, IIFL Securities, Electra Green Tech, and GSK Pharma. All of them will be reacting to positive news flow. On the flip side, you have Sugar Stocks, 5-Star Finance, and Titagarh Wagons that will be reacting to negative news flow.
All right, well, so that's essentially what's coming up here over the next hour or so. Now, RBI Governor Shaktikant Das will announce the RBI MPC's decision at 10 this morning. CNBC-TV18 Citizens Monetary Policy Committee expects the central bank to maintain status quo on rates. They also expect RBI to sound hawkish. The panel was divided on RBI raising its growth forecast. Let's take a look.
The first question is, what will the Reserve Bank and the MPC do to interest rates on December 8th? So,
no change.
No change. Pause. Shaumya? Shaumya?
I think it will pause.
Okay. Sajid? Pause. Okay, I think you're on mute. I could lip read you.
Pause, yeah.
Sonal?
Pause.
Okay. Dr. Sen?
Pause.
Okay, this is an easy one. Withdrawal of accommodation is the stance. Will that be retained, Shamiran?
I think at least for this policy.
Okay. Soumya, what do you expect?
It will continue to retain withdrawal and accommodation given the current inflation objective.
Okay, same as Shabir. Sajid?
Retain it.
Okay,
Retain the same chance.
Sonal?
Retain.
Oh, Dr. Sen?
I would move to neutral.
Yes, sir. You have held that view. I don't know how the Reserve Bank is going to manage that transition, though, as and when they do. Well, a quick third question. Will Reserve Bank change the growth forecast from the current 6.5? If yes, to what? Shamil, you say that first.
I think the Reserve Bank is likely to revise it upwards to around 6.8% or so.
Okay. Oh, 6.8. Yours?
Maybe around 6.7.
Okay. Sonal?
Raise to 6.7.
Okay. Sajid?
Raise to 6.7.
Dr. Sen?
Retain 6.5.
Okay, there's a Citizens Monetary Policy Committee here at CNBC-TV18, but Lata is right here with us with the editor's take on how to kind of read this and kind of tying in, of course, what the market is going to watch out for as well. Lata, over to you.
Well, as one can see from the Citizens Monetary Policy's voting, the market is prepared with a business-as-usual policy. What is a business-as-usual policy? It has been a hawkish pause. That is, the Reserve Bank will say we are still interested in that 4% CPI, and otherwise just cut-paste the October. No change in rates and stance being withdrawal of accommodation. But the difference, of course, will be that the market will want to look for any new growth and inflation forecasts. This is the base case of the market. But I just want to remind all of us that we've been wrong on 3 past occasions when we went with this expectation. In August, the Reserve Bank surprised us with that ICRR, you remember, incremental cash reserve ratio of 10%. In October, they surprised us by brandishing the OMO bond sales threat, that we want liquidity to be tight and therefore we may even sell bonds via OMO. And in between policy, and now they've surprised us with those risk weight increases, which again had a concomitant impact on interest rates and, of course, on the bond markets, the CD market as well. So we have to be worried when, the consensus, including myself, believe that the Reserve Bank will once again repeat the hawkish pause. There is a chance that they will look at, very steaming growth. When you run faster than your normal potential, you may fall. So very aggressive growth of 7.6 can scare central banks. Actually, Powell is in the same position. 5.2% US growth is not normal US growth. So that's why the worry to not indicate a rate cut or a normalization. The Reserve Bank could be worried about that, and the fact that it will be 6% inflation this month, November and December, can move them, to do something. Now, what is that something? More risk weights, or God help us, is it a CRR hike? So I would say that the base expectation is a hawkish pause, but if they do some surprise like they did in August and in October in terms of an action surprise, then the market's not prepared for that.
Okay, thanks a lot, Lata, for that. But we're not just tracking the RBI monetary policy, right? We're also tracking the Fed's policy decision next week. So let's listen in.
Non-farm payrolls.
And the non-farm payroll. So we have a lot on our plate, actually. Let's listen into what the former Fed Vice Chairman, Richard Clarida, expects from the Fed meeting this time around. We'll come back.
Disinflation progress really has been remarkable in the last 24 months. And so the amount of heavy lifting the Fed needs to do from here on is certainly not all that much, we would think. In fact, we think the Fed thinks that they're done. There is a risk that they may need to do more. The Fed has indicated, and we think that Chair Powell will repeat this on next Wednesday, is they can start to think about cutting rates even before inflation gets to 2 if they're convinced that the progress is real. We do believe that the 5 cuts that are priced in for next year look aggressive to us. That could happen in September, for what it's worth. The last time the Fed did its projections, it had 2 cuts next year. And something in that 2 to 3 range probably as a baseline makes more sense than 5. In terms of sitting in the room, yes, I had that privilege for nearly 4 years. the Fed is looking at a large body and range of data, but at the high level, they're going to want to be convinced that, inflation is less than 3% and on its way to 2%, and they'll be looking at not only the price numbers, but also the wage inflation data as well. But as inflation does continue to fall, they'll entertain rate cuts starting next year.
All right, let's slip into a quick break on that note. On the other side of the break, our entire team will be joining us to help us with a list of top 10 stocks as we begin a brand new day of trade.
CNBC-TV18, embarking on a quarter century of excellence.
Stock market, huh?
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back, folks. Well, for now, the market could be in wait-and-watch mode as we have the RBI policy upon us. Of course, there's no rate move expected this time around, but the commentary is going to be watched out for. Let's get our entire team to tell us about all the stocks that you need to watch out for today. And the sugar mills will definitely be in focus. Sonal is here to appraise you on the latest on that front. Sonal, hi, good morning.
Good morning, Sonia. Well, sugar stocks have been under a lot of pressure in last couple of trading sessions, and finally we know why. Media reports suggested earlier that there could be some ban, or I would say mills would not be allowed to use sugarcane juice and bee molasses for production of ethanol. Instead, they'll have to divert it to production of sugar. But now the news is that they've asked mills not to use sugarcane juice only for ethanol output for 2023 and 2024. Supply of ethanol for existing offers received by OMCs from bee molasses will continue, and that is something which companies are calling a relief as well. Now, this decision would result in lower diversion towards ethanol. The current sugar production, which is at 29 million tons, could be increased by 2 to 2.5 million tons because of this step that the government has taken. Now, DAM Capital had written a note yesterday during market hours where they said that sugar production in Maharashtra and Karnataka is likely to decline by 30%, and this measure would result in reduction in ethanol volume estimates for FY25. But now we do not know what these estimates would be, because the expectation was that both bee molasses and sugarcane juice would not be allowed, but now there's some relief that only sugarcane juice is not allowed. However, they are of the view that these measures are temporary due to expected decline in sugar production, but overall earnings in FY25 could be impacted because ethanol is a high margin business for these companies, and they will be getting lower volumes from that from here on.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Abhishek. He's here to tell us about some stocks around the news. Morning, Abhishek.
Morning, Nigel. So, sources do tell us that Zomato block deal will be taking place today. So, SVF growth to sell about 1.1% stake in Zomato. The offer size is about 1,127.5 crores. So, the city is the banker to the deal, and the floor price is around 120.5 per share, which is a discount of about 1.2% to yesterday's closing price. Again, sources tell us that 5-star block is on radar. Matrix Partners, TPG Asia, as well as Peak XV to sell stake. Issue price is around 730 per share, which is a steep discount of 3.5% to yesterday's closing price. So stake sale will be about 5.87%, and there is an option to upsize it to about 8.8%. The issue size, base issue is about 1,250 crore, which can be upsized to a little more than 1,875 crore. ICICI Securities and others are the managers to this deal. Now, Titagarh Rail has launched QIP. The issue size is about 700 crores. Indicative price is around 933 per share, which is a steep discount of 4.4% to SEBI floor price and about 5.2% to yesterday's closing price. Equity dilution, that could be around 5.6% level, and Nuvama Wealth is the book running lead manager over here. Back to you.
All right. Thanks very much for that, Abhishek. More stocks with news flow. Vivek is here with that list. Vivek, hi, morning.
Well, good morning. Quite a few stocks on the radar. First on our list, IRB Infra. The company has released the November month toll updates. The November toll collections have jumped up by almost 19%. The company says this is despite the fact that during the period of Diwali, company did see subdued collections. Now, what the company is saying is that H2 or the second half of the year is expected to be much better for toll collections, and they are now expecting the growth momentum to continue. Along with that, a new project, that is the Gujarat BOT project, will commence tolling operations soon. So going with a green on that particular name. The other stock on our radar, Jindal SAW, the company has informed the exchanges that they are going to be holding a board meet. This is in order to consider fundraising via the QIP route. And lastly, IRCON OFS, the company has decided to go ahead and exercise the green shoe option. So another 4% equity would be divested via the OFS route. So a total of 8% equity would be divested by the government. Now remember, when you're talking about the clearing price for the non-retail portion, it has been set at 158 rupees a share.
All right, thanks a lot for that. Well, let's hop across to Upasana now. She's tracking some more stocks that are in the news. Upasana, what do you have?
First up is IIFL Securities. SAT has set aside SEBI's order dated 19th of June 2023 prohibiting the company from onboarding new clients for a period of 2 years as a stockbroker. It has also reduced the monetary penalty to almost 20 lakhs for the orders dated in May 2022. Well, next up is Electra Green Tech. The company has received LOA worth rupees almost 63 crores from Vasai Virar City Municipal Corporation of Mumbai for supply and maintenance of 40 electric buses. This order is on an outright sale basis and shall be completed over a period of 7 months. Well, next up is GSK Pharma. The company establishes an omni-channel team to expand its reach and coverage to the target segments. Company seeks to target segments by leveraging technology and improving the productivity. It has also spent an amount of almost 157 crores as a one-off cost towards the voluntary retirement scheme.
All right, very helpful. Thanks a lot for that. Well, let's do a quick recap in case you missed out on any of the stocks. Stocks with positive news flow, there's Zomato, IRB Infra, Jindal SAW, IRCON, IIFL Securities, Electra Green Tech and GSK Pharma. While stocks with negative news flow, there's 5-Star Finance and Titagarh Rail. But
all right, well, those are all the top stocks we tracked, but Sudarshan joins us as well to tell us all the top brokerage notes that he's picked up for the day. Morning, Sudarshan.
In the list of brokerages today, we have 3 stocks from Nifty. First one is HDFC Bank. Macquarie has an outperform rating and target is rupees 2110 per share. It says company expects margin of over 4% in 4 years and management indicates RBI's action on unsecured loans was necessary. Also, management does not expect a significant increase in pricing and company expects to increase rates in the range of 25 to 50 basis points. Next one is Maruti. HSBC has a buy rating and target is rupees 12,500 per share. It says increasing CNG availability may augment its market share by 50 to 100 basis points and competition is rising in CNG passenger vehicles, but it expects Maruti to hold its share. Next one is Shree Cement. Jefferies has hold rating and target is rupees 25,750 per share. It says initiatives around energy efficiency, rail mix are driving a premium product mix and organic expansion will help reclaim leadership in EBITDA per ton and volume growth. Also, valuation premium may increase against peers if company sustains its outperformance.
Okay, that's very helpful. There are a lot of brokerages coming in, especially on these consumption companies, whether it's Maruti or something like a Shree Cement as well. But let's find out what's happening in the world of commodities. One good thing for our market is that Brent crude has cooled off a lot. It's now at $75 a barrel. Manisha Gupta is with us to give us all the action from across the globe. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, yes, the Brent, pardon me, the Brent also is trading at a 6-month lows and we are headed for a weekly decline, down by nearly 6% for the crude oil prices. This is because of the robust supplies and we also are looking at the weak demand from China. The imports have declined by 9% for the month of November. Pardon me. Also, if you look at the Indian demand, after hitting a 4-month highs in the month of October, the month of November has seen a decline in demand. But all these markets are looking for the U.S. non-farm payroll data that comes in today. And ahead of that, we have seen a decline in dollar and strength in metals like gold, copper, steel. All of these are trading in the positive side.
All right, Manisha, thanks very much for that. So that's what's happening on commodities and oil, very much in focus. We'll come back with Siddharth Khemka, Head of Retail Research at Motilal Financial Services, for some fundamental stock talk. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence.
India Bulls.
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Hope you're having a good Friday morning. Well, we just listed out all the stocks for you. Now let's get in some fundamental analysis from our expert. We have Siddharth Khemka, the head retail research at Motilal Oswal Financial Services, who joins in. Hi, Siddharth. Morning. Thanks so much for joining in. Well, Siddharth, I want to start off with one of the big losers yesterday first up. That's Paytm. The stock was down more than 15%. There was a negative news flow that came that could impact sub 5% of their revenues. Do you think the correction was over-exaggerated on the downside? Would you be a buyer at these levels, or would you just wait by?
Yeah, very good morning, Nigel, and to all the other panelists and viewers. And congratulations to CNBC on 25 years of showcasing business and economy to the market. So very congratulations to all of you. So coming to the question on Paytm, yes, I think there was some exaggeration in the reaction to what Paytm share price did yesterday. But what we generally see in the market is that market reacts on a very you can say sharply on either ways, be it in the fear side or be it on the greed side. And that is what we see that because of the good growth that Paytm was showing, especially on the loan disbursement side in the past few quarters, market or street was very optimistic on that front. And post what the RBI came out with the guidance and kind of showed concerns on the personal loans and some of the retail loans which were kind of heating up, the company has taken a step. It's kind of a speed breaker that you would see that although it's a small portion right now, about 4 to 5% of personal loans in less than 50,000 category, postpaid loans are also not that big in terms of contribution to the overall loan book. But it does highlight that there could be concerns in terms of the way the retail loan is being disbursed, and that is where I think it's a good course correction for Paytm as well as for some of the other NBFCs right now. Again, as we said, post this event, we have taken an estimate cut of about 15 to 16% in terms of disbursement estimates, which has resulted in an 11 to 16% cut in our overall EBITDA estimate. Nonetheless, if you see the remaining businesses, the rest of the businesses are doing very well, and the growth, although a bit slower from earlier expectations, continues to do well, be it in terms of the merchant devices that they are placing, the loan disbursements in the other segments, the UPI transactions that they are able to do, and that continues to do well, and that makes us positive on the overall business. Valuations still look attractive because the company has kind of turned around in terms of profitability, and the growth will only be sharper from here. So I think bearing maybe the market will want to look at 1 or 2 more quarters results to see the kind of impact this change in business strategy will bring in. And then I think the growth story, the focus on the growth will come back. So we continue to maintain our positive view on Paytm. We have, because of the cut in estimates, we have also lowered our target price. Nonetheless, it still is at a much higher level than current level. So our target price is 1025, which gives a significant upside from a 1-year perspective.
Okay, 1025 on Paytm. That's a big upside, but the stock has had a huge beating. Siddharth, hi, welcome to the show, and thank you for all your wishes for the channel and for the team. I wanted your thoughts on Maruti because, you know, HSBC has put out a note this morning where they have a 12,500 rupee target price. And they talk about how Maruti is making big strides in the CNG space now because, you know, the penetration has gone up 25% pan-India in the last couple of months. Are you as optimistic on Maruti, and what would your target price be?
Yeah, Sonia, good morning. So I think we are also very positive on the entire auto space per se, within which Maruti has been doing well in the last couple of quarters. We also have a buy rating with a target price of 12,300. So that gives a good, decent upside from current levels. If you look at the festive season has been pretty good for the entire auto space, especially on the passenger vehicles and the two-wheeler side. Maruti continues to do well with its new launches. And we have seen the shift in the passenger vehicle segment from the small vehicles to now the utility vehicles. So the SUV side or the mid SUV segment, where Maruti did not have too many offerings. They have been putting out newer products, be it with the earlier Brezza, now with the Grand Vitara. The Jimmy has been recently launched. They have all seen good offtake, and that is where the market share gains are coming in from. CNG is another space where Maruti has kind of kept a clear leadership. But the story for the passenger vehicles clearly should be focused about the core business and the upcoming EV business, where Tata Motors has taken a lead, and Maruti is yet to launch any product. Toyota, their global partners, are working on it, and they may be launching some products in FY25, FY26, but that is still some time away. Barring the EV business, I think the remaining business continues to do well, and we continue to have a positive view on Maruti.
Positive view on Maruti. Let's just talk about sugar, if you will. Siddharth, morning.
Morning.
The directive from the government. I mean, the idea seems to be that use, grain-based ethanol is okay, but, divert sugar only to the extent that it is excess for ethanol, right? A cane, basically. How much of a negative is this, in your opinion?
So I think, Prashant, morning. So I think this is not a news flow in the right direction. I think till now, what we had been hearing from the government about the overall ethanol story and how government would look at increasing the blending rate in India without getting into the source. And to be honest, in India, sugar has been one of the biggest sources for ethanol. Now, with the concerns coming in, especially for the sugar prices, there has been some concerns from the government side. And I think yesterday we've got news flows in the either direction. In the midday, we got also news that government has denied that. Then again, we got confirmation by the end of the day. So these kind of news flows definitely does not help set a positive investor sentiment, especially for a sector which is highly regulated. Now, that also brings me to that concern that in future, if their grain prices or grain supply comes down, government might also look at curbing ethanol supply from that as well, which could be detrimental in the long term, the investor sentiments, at least for the near term, until there is a clarity emerging. Nonetheless, as you rightly highlighted, the current blending rate doesn't change. There is definitely an excess sugar production. There's a lot of capacities that has been created, and that is in the pipeline to cater to the huge ethanol requirement. The government, on its part, the Indian government has also gone and done this Global Biofuel Alliance, where we were to be looking at not only providing to India, but in future, with the excess capacity, we would have also been a big supplier to some of these global regions. So all these things definitely put a question mark on how the ethanol story for sugar companies could go forward from here.
Okay, all right. So that we'll try to get further details on that. Actually, how much of the ethanol that's produced is from B, C, and sugarcane. So we'll try to get that bifurcation and the potential impact on these sugar companies. Request you to stay with us. That for the time being, we'll slip into a short break. You come back, we'll go to our technical experts who will be joining in. We'll also get in further details in terms of this big breaking sugar story. Stay with us.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Okay, welcome back. You got the market, which is about 15 minutes away from the pre-open, and it's going to be a decent start, as the GIFT Nifty is indicating, about a 40-odd point higher start. Siddharth Khemka of Motilal is still with us. Siddharth, thanks for staying on. Just a quick word on this week actually belongs to, of course, public sector. So even yesterday, as the Nifty did not do very much, the CPSE index was up another 1.5%. What are the best ideas at Motilal, to play the entire PSU space? We had, Ramdeo with us yesterday. We had Sridhar Sivaram of Enam, and we put that same question to them. And their idea was to buy a basket of PSUs without kind of trying to pick this or that. And to that end, they were saying, well, retail investors should buy maybe a mutual fund. And there are a few out there which offer that opportunity. Or maybe the PSEBs, which again gives you exposure to a wider basket. Your thoughts, Siddharth?
Yeah, Prashant. So I think if you look at the entire economic background, Indian economic growth has been pretty strong, and one of the biggest factors has been the expenditure or the capex push from the government, which has been consistently helping the Indian economic. Private capex cycle has definitely picked up, but it is still in the emerging space. So I think that is a space that the government spending, and now with the state election outcome, there is a fair bit of comfort in the market that the policy continuity will be there, and that should help the government, public sector, enterprises across spaces. But mostly, if you see, these are core industrial sectors, be it the power sector, be it the defense, railways, capital goods. So I think it's a right approach. This entire space will do well if the Indian economy continues to do well. The industrial growth is pretty strong, and I am not including the public sector banks for now in our discussion. And as you rightly highlighted, the public sector, the PSE ETF is another good way to participate in this story. But definitely, if you look at from a investment perspective, sectors like a capital goods space, which also includes the defense and to some extent the railways, because there has been consistent increase in order book. The delivery has been also in terms of delivery, they have been doing very well. So both the private capital goods as well as the public sector enterprises, I think they will continue to do well.
All right. Well, let's find out more about this, news flow on the sugar companies. Remember, the government has asked sugar mills to not use sugarcane juice for ethanol output in this 23-24 period. This would result in a lower diversion towards ethanol, and it could impact the profitability as well. Prashant Biyani of Elara Securities joins us now to put focus on this. Prashant, thanks for joining in. Can you just explain to us, for the benefit of our viewers, this curb on ethanol production? How would it impact, the listed entities, the sugar mills, and what is the impact particularly on profitability? Have you done any numbers?
Yeah, so sugar production for the companies will increase. It can increase to the extent of 10 to 15%, and ethanol volumes are going to be lower. Now, depending on which company we are discussing about, but for some companies which are under coverage, the sugar production could increase by around 14 to 15%, whereas ethanol volumes can be down by around 20-25% over the next 18-month period. For H2 24, the numbers may not be that impacted, but the main impact we are seeing could be in H1 FY25.
Okay, got it. All right. Hi, Prashant. Thanks so much for joining. Request you to stay with us. Kaustubh of Sharekhan as well joins us on the show. Hi, Kaustubh. Good morning. Thanks so much for joining in. Well, Kaustubh, I wanted to get one basic number out first. Out of the total ethanol that we get from the sugar industry, break it up for us. How much is from B, C, and from sugarcane for the industry on the whole?
So approximately around 65% of ethanol is manufactured through BAV molasses, and around 25% is manufactured from syrup, and rest is from the CAV.
So basically,
what? Yeah.
Sorry. Please go ahead.
Yeah. So now the notification suggests that you cannot manufacture it through syrup. but you can manufacture through B-heavy molasses. So that shift will be there from syrup to B-heavy molasses.
So that is, Kaustubh, so that in percentage terms, just to take that point forward, what percentage is impacted? 25%. 25%.
25%. Yeah.
Okay. Prashant is also with us. Prashant, to take your point forward, you said sugar volume should increase, ethanol should go down. What does it mean for, I mean, you would have done numbers for companies under your coverage. Just give us some sense on both, on earnings. What is the impact for the top companies under your coverage?
So for top companies, overall the EBITDA can be impacted between 4% to 25% over the next 18 months between H2 24 and FY25. Now, the most important thing is that, you know, what assumptions we have to build in for B-heavy ethanol contracted quantity, which companies might have got in the tender. So if the B-heavy ethanol tender volumes are high, then the impact on EBITDA could be less. If that is low, then the impact could be high on the numbers.
So, Prashant, you said that the sugar production could increase by 14 to 15% in the coverage universe. Can you name the companies? Which are the companies where the sugar production will go up, and which are the names where the EBITDA can be impacted between 4 to 25% in the next 15 months?
So for Balrampur, in our preliminary estimate, we expect around 15% increase in production. But depending on various percentages, sugar production will increase for all companies in India, and ethanol volume should also reduce because that is how the government wants it to be. So depending on the size of the company, all companies will see decline in ethanol volume if capacities are same, and sugar volume should increase.
And the EBITDA impact will be on which companies?
EBITDA impact also should be on all. It could be negative. It may happen that for south-based companies based out of Maharashtra and Karnataka, for them the impact could be limited because they were anyways getting impacted with lower production this year. So for them, lower ethanol volume may be a bit better in terms of opportunity because sugar prices are higher. So that way, their product mix may be a bit better than what we were earlier expecting.
Prashant, do you think this event, because it brings back a lot of uncertainty, it'll be a de-rating event of the multiple? Would you go that far, or do you think that since you believe that it's a near-term event and maybe there'll be relief that will come about, you'll think the multiple itself will not de-rate?
Multiple should not derate because government has been a bit concerned about the sugar production, and while it has created a lot of confusion, but at the end of the day the sugar production is increasing in India by only 6% in my view due to this. And for FY24 itself, we are not seeing any change in estimates for our coverage companies. So I don't see a de-rating of multiples due to this event.
A couple of more questions. Kaustubh, if you can, in a minute, tell us what is the difference between, very simplistically speaking, the different categories of ethanol, and why is the government kind of focusing on one, saying you can't use this and you can use the others? Very briefly, Kaustubh.
Yeah, so we need to understand why government has taken this step. So it is basically they are expecting lower sugar production for this year, which is expected to be lower by around 8% by the earlier numbers. So around 29 to 30 million ton production is expected after diverting sugar to ethanol. And overall consumption is expected to be around 28 to 29 million tons. So that gap has reduced a lot. So, and because of that, they are expecting that it might lead to inflation in the sugar prices. Now, if we don't divert sugar towards manufacturing of molasses, it might help to see production to be higher, as the participant said that it might increase. So there might be, the production would be around 31 to 32 million tons. So that gap, compared to the production and the demand would be a little bit higher, and that will help the inflation to curb. But this is too early because the production is yet to be out. The entire production numbers, are important from the month of December to March, to analyze the same.
Prashant, is it possible, because sugar has always been politically very sensitive, and elections are coming. Is it possible this is a temporary measure?
It will be a temporary measure if there is no intermittent change in notification, maybe at the end of January or maybe after that. But this notification is valid only for 1 year. So from next year, we are not. It would be business as usual for the companies. So there's not. It is not a game-changing event for sugar companies. It is only a temporary measure.
Okay. Finally, if you can tell us, Kaustubh, what is your estimate on how much the earnings for FY25 are likely to come down for the industry? Because there are some estimates suggesting that a 10 to 15% drop in overall earnings for FY25 is what they're looking at. Is that a reasonable assumption, or could it be worse?
Yeah, so there are a lot of factors which will determine the earnings in FY25. So this is one of the measures which the government has come out with. But ethanol pricing is yet for sugar season 2023-24 is yet to be announced. Secondly, the average, the state advisory price for the cane in Uttar Pradesh is yet to be announced, and how the production and the sugar price overall scenario would be. So these three factors would be very important to determine, what could be the earning assumption for FY25. And as we are discussing that, this measure, whether it is a temporary measure or it is for the overall year, everything depends on for the entire sugar season. Everything depends on that. So if government might change its decision, maybe at fag end or around February, March, looking at the overall production scenario, the numbers might be different. So at this, obviously, the impact would be there on the margins, and because of the lower ethanol production and shift to the BAV molasses. But it is very difficult to guess at this junction what could be the exact impact, because all this we are building on the assumptions.
Okay, all right. We'll leave it there, gentlemen. Prashant and Kaustubh, appreciate you joining in with that initial assessment, but thank you very much indeed. We'll take a quick commercial break here. We've got the market, which is about 3 minutes away from the pre-open, that is 3 minutes away. So we'll come back with that. Our technical experts will be with us, and so will some more trades on the futures and options side. Stay with us.
CNBC-TV18, embarking on a quarter-century of excellence.
Powered by
CNBC-TV18, embarking on a quarter-century of excellence.
Welcome back. In a few minutes, we'll have the pre-opened rates, but for the time being, let's get in some technical strategies for the day. Srikanth as well as Mitesh are joining in this morning. Good morning, gentlemen. Well, we got the big event that will be out in the next 90 minutes or so. But how do you approach trade? What are the levels you're looking at on the Nifty? Mitesh, you go first.
Morning, Nigel. So, we've been advocating that this market remains biased on the positive side, except for the fact that we are slightly overbought on the hourly and the 2-hourly charts. But I think use any declines to buy into. Yesterday, we fired a buy call on Bank Nifty around the 46,500 mark. Similarly, on the Nifty, the corresponding levels would be closer to about 20,700. In case you get a dip, buy more. Otherwise, stay long and just keep trading your stop losses. I think this market will see further higher highs, and the next few days, few weeks should be very positively biased.
Okay. Gentlemen, morning. Srikanth, what about you? How are you poised?
Good morning, Prashant. Well, for Nifty, I think it is going to consolidate within the range of maybe 21,000 on the higher side and 20,800 on the downside. So till the markets are not crossing 21,000, we are not expecting any major thing to happen on the indices. But for Bank Nifty, yes, above 47,300, we are expecting a breakout sort of formation, because Still, there are like a few short positions, and above 47,300, we are expecting Bank Nifty to move towards 48,000. So that should be on the watch list. And today's credit policy will decide the next specific trend for the Bank Nifty. That's the overall view on the indices. But if we go through with these stocks, then in that we like Nagarjuna Constructions, which is currently around 174, 175. It is in the weekly monthly breakout. The next level to watch out for would be 195. So it's a buy at current levels with a stop loss close to 168. And the other stock which we like is Hindustan Copper. Few metal stocks are definitely going to do well because most of these stocks are crossing above their important resistance level. Here also we are expecting somewhere close to 195, 200 sort of levels for Hindustan Copper, and we can keep stop loss at 177.
All right.
Okay, well, let's just get some specific trading ideas as well. Mitesh, you go first. What's on your list?
So I have a buy on ICICI Bank with a stop just below yesterday's low of 987. Look for targets of 1025. Glenmark is appearing to be getting out of a consolidation and into an uptrend. So buy here with a stop at 807 for targets of 850. A buy on Bata with a stop at 1644. Look for targets of 1692. And Loris Labs is the final buy call. Keep a stop below 380. Look for targets of 410.
All right. Thanks a lot, gentlemen. Thanks for joining in. Well, let's focus on the consumer stocks now. Abneesh Roy, Executive Director at Nuvama Institutional Equities, joins us now with his call on consumer companies and specifically his call on HUL. Abneesh, thanks a lot for joining in. Appreciate your thoughts here. I wanted to talk about HUL's recent commentary where they spoke about how the urban demand is resilient, but the rural demand is also showing some gradual improvement. So it looks like everything is coming together. Your thoughts on what this could mean for consumption companies over the next, say, 12 to 18 months, and what's your pick of the pack?
Sure, thanks. Our current topics will be more urban-focused companies or where there is a leadership change which is driving a lot of transformation and where there is a correction in the key raw materials. Our topics currently will be Nestle, United Breweries, Tata Consumer and Colgate. Coming to Hindustan Unilever, in Q3, we expect that the status quo will largely remain. Rural demand continues to remain a challenge for most of the companies, including HUL. So basically, there is also local player competition, which started, say, in Q2 in terms of the lower-end detergent and tea. That will continue for 1 or 2 more quarters. Also, the gross margins will dip a bit quarter on quarter. It will improve YOY. EBITDA margin and gross margin, but quarter-on-quarter slight dip will be there because if you remember initial Israel-Hamas crisis, the crude had jumped to 95. But in Q4, Hindustan Unilever will see expansion in margins. So Q3 bit muted, but in Q4, the margin recovery will start. And FY25, Hindustan Unilever should see positive pricing coming back. Q3, the pricing for HUL is likely to be slight negative and volume growth also muted. It will be a growth. So overall, currently, urban-focused companies are growing faster. Rural continues to remain a challenge for most of the FMCG sector. Paints and jewelry has seen a good Q3, good festival demand. So those are the companies which will do well in Q3.
Abneesh, hi, morning. You mentioned United Breweries. Its stock's done nothing this year. It's been flat for the last 4. We had the management, the new CEO and MD with us 2 days back. And they basically told us that industry is growing at 5 to 7%. They should outgrow the industry. Premium segment will grow much faster, where they've kind of struggled. Across not just UBL but across the category, is it just a relative kind of call now that stocks have not moved, valuations have not come off, but stocks have not moved? So maybe money will rotate into these names, or is there real growth excitement here in the space?
Good question. Yes, there is a real excitement because from Q3, you will see the gross margin and EBITDA margin see further recovery because the high-priced inventory of barley, which was a challenge because of the Ukraine crisis, that got over in Q2. The new MD is not just focusing on premiumization. He's very clear that the lower end also has a huge opportunity in terms of revenue and profits. So that will also lead to better volume growth. If you see even in Q2, the premium volume growth was 10%. You're absolutely right. In terms of premium market share, UBL is under-indexed. The other MNCs are much larger. If you see pan-India market share for UBL is around 50%, But in terms of the premium, they are below 20%. So there is a huge headroom to catch up. Our sense is next 1 year, because of the new MD's much higher focus on aggression, innovation, new launches in the lower end, and even in the premium, Heineken has come out with a new draft beer, and they are going to have manufacturing in Karnataka. Our sense is the volume growth should become high single digit to double digit. Definitely in premium, it will be double digit, and gross and EBITDA margin expansion. So yes, UBL is not just a relative, it's an absolute also. The leadership issues have been resolved. The gross margins are also expanding.
Okay, Abneesh, got that. So you gave us a sense of the consumer names. I want to just kind of talk about one more name, specific name, Z, I think, where you have coverage. Stock is starting to show some excitement here. What are the next triggers? And, UBS a couple of days back had a call out where they said that sort of the broad thing was that they're not very positive on advertising revenue picking up. Not just for Z, they had, I think, Sun also as part of that note. But for Z, what's the big trigger? I mean, next 2 or 3 things which should work out if you have a positive view here.
We are positive. I think the biggest trigger should be the still slight confusion on the merger in terms of who will be the CEO between Z and Sony. I think discussions are on. I think that will be a near-term trigger, and we are seeing that the talks are happening. Media articles were saying that the breakup phase is there. As per our understanding, the discussions are happening, and it is going in the right direction. Coming back to your question, advertising, clearly, if crude is at a 1-year low, that's good for advertising because FMCG companies will see expansion in margins. Q3, as I said, HUL and a lot of FMCG saw a temporary blip when the results come out. But in Q4, that will be again back. Most of the recession is driving commodity deflation. So that will give more gross margin expansion for FMCG. Subscription also, if you see, should come back to that high single digit kind of a CAGR because the legal issues have been resolved. Plus, once the merger happens, there will be synergy benefits. So 3-4 things are there. But currently, the big trigger will be the confusion, which is still there slightly in terms of CEO. We are awaiting clarity on that.
Okay, that's on Z Entertainment. Well, do you track Nykaa by any chance, or any of these platform companies that have been doing quite well and have, sort of come back to profitability, or at least on their path to profitability? Anyone that you would put in your portfolio now?
Yeah, I think Nykaa is something which we discussed last time. The stock has given a decent return post that also. In Q2, the good things were fashion grew very strongly, and now Q3, if you see festival season, the company is taking corrective action there. In terms of beauty and personal care, also what we are seeing, there is a rational competition now. So irrational discounts, etc., reducing. So I will say yes, definitely Nykaa is looking like a good re-rating story from a 1-year perspective. Q2, we saw some evidence of that. But ultimately, sustainability of the fashion growth, which has been a key challenge, that is one more important thing. But in the core beauty business, clearly Nykaa is doing quite well. So we are positive on that company.
Okay, all right. Always good hearing your thoughts, Abneesh. Appreciate you joining in and filling us in with your take on various stocks. Wishing you a good day ahead. Well, let's go back to Mitesh. He's joining in to help us out with the 9-10 call of the day. Mitesh?
Yeah, I'll go with the buy on Glenmark with a stop at 807 for targets of 850.
Got it. All right. Thanks a lot for that, Mitesh. Well, let's hop across to Ekta. She's joining in to fill us in with the stock that's on the Momentumizer segment. Ekta?
Well, thanks for that. I'm watching ITI today. The stock was up around 10% yesterday. It's rallied 247% from its 52-week low and around 11% away from its 52-week high. Market cap of over 28,000 odd crores. It operates in the telecom equipment and accessories segment. It is a public sector enterprise. The government holds over 90 odd % and a part of the BSE 500. Now, the latest news with regards to this particular company is that there was a downgrade by a credit ratings agency on its debt. So, of over 4,349 odd crores and on a loan which they have taken from a public sector bank to the tune of 120 odd crores. However, the company is expecting a realization to the tune of 80 crores from its Ascon project by the 10th of December. And they have indicated, or rather the ratings agency report has indicated that they would probably look to pay off their current outstanding and immediate future obligations on account of the proceeds coming in. And separately, the company is also expecting a net project realization to the tune of 540 crores by March of 2024. So maybe these are a couple of triggers lined up for ITI, and you could probably see follow-on buying or maybe a move to its 52-week high in the next couple of trading sessions.
All right, Ekta, thanks a lot for that. Well, PSU banks are in focus this morning and Abhishek is here to tell us why you should keep them on your radar. Abhishek, over to you.
Well, Sonia, IBA bank unions have reached out a consensus with respect to wage revision. So annual increase in salaries will be at 17% for 5 years starting FY22. A wage hike impact for PSU banks and SBI seen at about 12,500 crore for FY22 alone. So DA, that is dearness allowance, to be merged with basic pay with a loading of about 3%. Ex gratia amount to be considered along with pensions for PSU banks, and bank unions urged that all Saturdays will be a public holiday for them before signing the wage agreement. So IBA has submitted a proposal for a 5-day week working for PSU Bank to Finance Ministry. Now, Macquarie has also written on banks. They say that brace for loan growth slowdown and margin pressure for the industry. Growth to moderate in unsecured and NBFC segment. We have seen RBI come out with rules on them. Retail and SME to remain the key drivers in the medium term with respect to growth. CASA is a big challenge for all the banks, and credit cost to normalize margin may come down in FY25 as well. Back to you.
All right, Abhishek, thanks very much for that. Public sector banks in focus there. Container Corporation, Concor is the next one. Mangalam is standing by. Of course, I mean, the big trigger is connectivity to the DFC, the dedicated freight corridor. DAM Capital has got a note out. Mangalam.
Well, they met, the management of Container Corp and they returned impressed. So here are some of the takeaways from DAM Capital's management meet. The first one, of course, is that the revival in port volumes and connectivity of the dedicated freight corridor to Dadri has actually worked well for the company. It's helped them recoup some of the market share as well as, volumes too. And they are also providing high value services like warehousing and first mile, last mile to their customers. So that works for them. The big trigger then will be the DFC itself coming all the way to JNPT. This is likely to be completed by the fourth quarter of FY25. And if that happens, then rail market share from around 18 to 19% jumps all the way to 30%, of which Concor will be the biggest beneficiary, as a result of which they have a buy rating with a target price of 930 on the stock.
All right, bang on time. Thanks a lot for that. Well, that's the first tick on the index in the green for the Nifty, hanging on to 20,900. In fact, just within kissing distance of the 21,000 mark. The mid-cap index is having a better showing, up almost 0.5%. That's almost 200 points in the green for the mid-cap index, and all 4 indices are in the green. So after taking a bit of a breather for the last few days, the market has come back, and how. It's important to see if we build on to our gains, but for now, the going is pretty good. So it's a positive start. What's leading from the front is a lot of these power, renewable energy companies which are doing very well. NTPC is up almost about 1%. Adani Ports is up 1.5%. Adani Group stocks have been doing very well. Adani Enterprises is also in the green. L&T is up about 0.5%. JSW Steel, M&M, Tech Mahindra, ONGC, ITC, Power Grid are a couple of other names that are in the green at the moment. What's not doing that well is 2 banks. ICICI Bank and SBI are a tad bit in the red. So that's why the Bank Nifty is not performing. And we were talking about how the Bank Nifty needs to perform for the market to get convincingly above the 21,000 mark. But there are some PSU banks which are doing well. So Punjab National Bank, etc. are in the green. Dr. Reddy is also trading a tad bit in the red. So keep an eye out on that. And there is plenty that's happening in the broader markets too. Just, a couple of these names. There's some news that's come in that the government has revised the wind repowering policy, saying that old wind farms with low rating turbines will be replaced with new high rating ones. Just pull up a couple of these names: Inox Wind, Suzlon, etc. Could be in focus. There could be some positive sentiment reaction because of this. So, just keep that on your radar as well. But other than that, it's a decent opening for the market. There you have it. Inox Wind up almost 2%. Suzlon also in the green.
Well, that's right, Sonia. A few more stocks to look at. IIFL Securities, that stock is up more than 10% in today's trading session. So big move being seen out there. We told you that 5-star finance is likely to be a large trade. That's taken place, and that's why that stock is down closer around 3%. Sugar stocks, because of the cap in terms of potential ethanol production that will come out of them. You have Sri Renuka Industries, Bajaj Hindustan, Balrampur Chini, all of them under some pressure. The sugar production will go up, but the ethanol production will come down. Net, it's going to be a cut in earnings estimate. So that's why all those stocks are struggling a little bit. And the next order impact will be on Praj Industries, because that's a proxy play on ethanol itself. So that as well has lost closer around 5% as we speak. A couple of stocks as well that deserve mention because of high volume. GMR Power, well, that one is up close to around 5%. Massive volumes out there. And Paytm is bouncing back close to 2% after the kind of dropping that we saw yesterday. So Fair bit of action from the broader markets. Headline index, though, is holding with a gain of around 50 points. And the Nifty Bank not moving too much. Waiting by for a cue coming in from the Reserve Bank of India governor. In the next 90 minutes or so, that event as well will be out of the way. Prashant.
Basically, Nigel, we are back at day before yesterday's levels. The high day before yesterday was 20,961, and the high today is 20,955, essentially, about 5 or 6 points away at the day's high. So can we build on this, or will we kind of wait a little bit more here after the rally that we've seen? Just a few more names before we go any further. Market breadth is very strong, so advances far outnumber declines. Look at Z Entertainment, if you can have that up. Z is up 4%. We were just discussing Z with Abnish 2 minutes back. Stock's at about 283. It's a big move. It's coming on the back of very strong and very large volumes as well. Yeah, there you go. That's Z. IRB is up 6%, so that's coming up again with huge volumes. IRB is up at about 40, 41 or so. The Adani Group stock, which is off to the races once again, is Adani Total. Adani Total, of course, had lost the most and recovered the least, and that is up another 7.5%, ATGL basically. So we'll put that up. We mentioned IIFL Securities earlier. Orchid Pharma, I think we mentioned Orchid Pharma is up about 15%. So again, off to the races here. Big volumes as well, 650 in Orchid Pharma. Spencer's is up 7%. The stock's at about 107 rupees. I'm mentioning because it's got volumes on it. Nosil, which is basically ancillary to the auto space, rubber chemicals. That is, Nosil is starting about 3.5% higher. Very large volumes here coming through. And you've got something like a Reddington, which starts up big time as well. Now, on the downside, we already mentioned a few. I'll just take a few more to put on the list. 5-Star starts about 3.5% down. 5-Star, of course, is the Chennai-based finance company, 732, and been listed, I think, listed earlier this year. You've got Praj, where sugar, and of course, Praj, the ancillary there is all under pressure, and I think that is to be expected after the news flow around here. MCX went up sharply yesterday. MCX starts slightly lower. It's about a 0.5% pullback. And Sterling and Wilson Solar, which has been running up one way, 5% circuits every day. That starts about 2.5-3% lower this morning. So that's basically the overall picture as we start this Friday's session.
I just one mention on IRB Infra, right? The stock is now one of the big movers in the broader markets. We mentioned that briefly, but 6% higher.
Yep.
And look at the volumes. Almost 2 crore shares are being traded on IRB Infra at the moment. The toll collection was very strong. Almost a 20% growth is what we saw in toll collection. And the management said that the second half of the year will be better. So commentary is also quite good. And I think that's why the stock is surging.
Well, things are looking pretty solid and lots of buzzers out there, as we've been pointing out. Tahir Barsha is now joining us, Chief Investment Officer at Invesco Mutual Fund. Tahir, great to have you with us here. Thank you very much for your time. Tahir, you've been steadfastly of the view that there are opportunities still in the broader markets, mid-caps and small caps, even as others have kind of pulled their hand back. Just wanted to understand, one of the things which I think is lesser discussed, we kind of talk about the overall picture, top-down view, mid-caps, small caps, valuations, etc. But as someone was pointing out, maybe the reason why this space is doing very well is because they much better represent sectors where there is a lot of activity, manufacturing, industrials, materials, right? As opposed to, say, the Nifty, where the weight of these sectors is much smaller. In the mid and small caps, the weight is much larger. Almost 0.25% of the mid-cap and the small-cap index is made up of these sectors. I just wanted to start with your thoughts on this, Tahir.
I couldn't agree more, and we've been kind of, pushing the case for mid and small caps primarily on that front. Our enthusiasm on mid and small caps continuing to probably perform. I mean, there could be obviously interruptions in between, but by and large, the cycle is basically predicated on the fact that the domestic economy is doing well, and we are intrinsically positive about the domestic investment cycle and the domestic economic cycle. And most of the mid and small cap companies, many of them, I wouldn't say all of them, but many of them actually are more levered to our domestic opportunity, not as much to the international or the global opportunity, which is probably more the case with some of the large caps, if not all of the large caps. So I think that's precisely what we've observed in the past as well. Even in past cycles when mid and small caps have actually done well, it has coincided with periods when the overall domestic economic situation has been better. And so I think that's the bedrock of our enthusiasm out there. So I'm absolutely on the same page with you on this.
Okay. Tahir, hi, good morning and thanks for joining in. And you know, this is a great time to be putting money to work in new sectors, right? Growing sectors, sunrise sectors as we call it. And one of the spaces which is doing very well is renewable energy. We were just talking about how names like Inox Wind are up almost 25% this week. Tata Power is at a new high. JSW Energy is at a fresh 52-week high. And these are companies that are doing a lot in the renewable energy space. You think the time has come for investors to put more money to work here?
Yeah, I think there are quite a number of opportunities, particularly on the ancillary side, even in the solar and the renewable space. And I think not just solar and wind, but or renewables as such, but even as you know, non-renewables and the traditional fossil fuel related power entities are doing much better now than what they were doing earlier. And it's all propelled by the fact that manufacturing in India has started to look up, and we've seen power consumption hit records in terms of growth after a very long period of time. So I think this whole area will probably buzz, and there will be opportunities. There will also be newer companies which will probably seek the capital markets. So we have some exposure to some of the traditional as well as some of the renewables as well in our portfolios. And I think you're right that this is also the space which will keep attracting attention from the newer category.
Hi, Tahir. Good morning. What about the PSU basket? You know, the total market capitalization of these companies, put it together. Yes, we have an LIC that's been included in the last 18 months or so. It's 50 lakh crore. Now, valuation-wise, some will argue that still that entire basket is quite attractive. But sometimes, you know, you have government interference, change of policies that makes things tricky. From the PSU basket, do you all still believe there is value in select pockets? If yes, which are they?
So, Nigel, in our scheme of things, in our definition, actually, PSUs, we run a PSU fund, by the way, as you know, for a very long period of time. And up until a couple of years ago, PSU and the fund itself was basically premised on the fact that it was significant value. It was trading at valuations which were below their own, historic valuations level on the market. They've always traded at some discounts to the market in general. But from there onwards, I think we've seen performance, and performances essentially come more on the back of now the growth visibility in many of these PSU-related entities, because they dominate some of the so-called commanding heights of the economy, and therefore, they are obviously the natural beneficiaries. So once again, going back to the fact that these are domestic sector plays. And but now for us, what we are saying, at least as far as the whole PSU space, is that we are not necessarily buying them now for that absolute value which was available a couple of years ago, or up until a couple of years ago. It's more a growth play now. So you have to pay them for their growth. You have to pay the valuations for the growth opportunity that you have in front of them. In several of them, whether it is some of the industrial, it is maybe even in some, maybe perhaps in the oil and gas space, I think we can still seek some value as far as PSUs are concerned. But by and large, I think for most others, it is now a growth objective.
Tahir, actually, yesterday, Sridhar Sivaram of Enam was making exactly that point. He actually took your fund name. He said it. He said Invesco runs a PSU fund, and we were asking him how best to get exposure to that space, and he said, "Well, that's a great way to do it." Kudos to you guys for having, and it's a smaller fund, so it still gives you opportunity to do
yes,
well.
And we've got a very stellar record, I would say. I mean, I've been surprised at times that when I look at some 7-year, 10-year performances, I find the PSU fund has actually beaten the Nifty. I mean, I wouldn't have probably imagined that. Yeah. So come through. So that's something which is.
You said incrementally there's in PSUs, oil is the sector where there's still perhaps upside, right?
I would think of them as value, not as much of growth. We would buy them for value proposition, whereas most others have actually, now you have to think of them in terms of whatever you are paying, is it adequate from the point of view of the growth that they're likely to demonstrate?
But when you say, yeah, got it. But when you say value, you mean because of the dividend yield, etc., by that metric, or because value can stay value unless it is people start to value that value.
Yeah, absolutely. So there could be.
There's got to be that growth element as well. But you're saying there's not that much growth element here. So go on.
The good part now in PSUs is that there is value with some triggers. So you at least have some catalysts which actually can, as you rightly said, crystallize that value opportunity in the market. And that's exactly what they were at some point in time. Some of the other sectors in the PSU bucket were, but they've now moved on to being more of growth entities, and what we would like to incrementally buy them for is probably the growth opportunity that they provide.
Okay. In fact, Prashant, you were talking about the Invesco PSU equity fund, right? If you look at the performance, in the last 1 year, the compounded growth rate is about 38%. The last 3 years is 31%. So it's been pretty stellar. By the way, that's the governor walking in and all ready to give the RBI policy announcement that happens in just a while from now. We'll be hearing from the RBI. Of course, there's no move on rates expected this time around, but any commentary, because see, inflation is cooling off and any kind of indication on a change in stance is something the market is perhaps waiting for. In any case, rate cuts are expected from the second half of the next fiscal. But, okay, we have about 30 minutes to go before the RBI monetary policy. But Tahir, I just wanted to, close that loop on this whole PSU space. We were talking about how the funds are doing very well, right? So in that context, there's been what, a 30% compounded growth rate that we've seen in the last 3 years for this PSU equity fund. In case someone has not invested yet, does it still make sense to do so?
Yeah, I think the backdrop is pretty solid that we have in front of us for the PSU segment to thrive from a growth perspective. And most of the elements, as we all know, are in place. Of course, it's always a little difficult at such times when you can't see any risk around the horizon. So you have to be also a little watchful. But I would like to think that we are in a good space as far as the opportunity is concerned, and most of the factors which actually drive PSU performance, both from the point of view of growth as well as value, are available. So I would like to think that there is still, up until the time that we have this domestic cycle, which is strong enough, I think they will continue to do that.
Okay. All right. Final question, Tahir, from mine before we let you go. What's the view on IT from here on? The sector has been quite strong given the kind of news flow. That there are still fears that maybe, in fact, 2024 will be a year of slowdown. How do you approach the tech companies?
Yeah, we are as confused as you are. And, I think at least we take comfort in the fact that, they will come back. I mean, they've got business opportunity in front of them, and they are obviously sitting on a good amount of business visibility, except that they have to contend for some delays in the short run. We are somewhat watchful as far as the US cautionary, I would say, as far as the US economy is concerned, and things can get a little pushed back. Earlier, we were expecting a first quarter, second quarter kind of performance out of the IT companies, but probably now it looks more like it'll get pushed into the second half of the year. So there's still time, but there could be some opportunities even within that space where the growth is a little more stronger, stickier, and they're not necessarily getting bogged down by delays. So some of the R&D companies, for example, are doing reasonably well. A few others too, even in the mid-cap space, for example, in the IT sector. So I think, it's a bit of a wait and watch out there, I guess.
Tahir, the other space where there's so great deal of optimism, and by the way, Sonia is going to later on Editors Roundtable put out a piece on that, which is essentially, I think, the rise in demat accounts, right? New investors who've kind of come in. Capital market plays, very bullish kind of sentiment out there. Tahir, so just what's the best way to capture that value, in your opinion? I mean, if equity markets stay buoyant, more people come into the market, I think, it's a space which will do well. There is exchanges, there are depositories, there are mutual fund plays, wealth management. But what's the best place to capture it?
So I think much of this ecosystem that you mentioned and most of these constituents actually are well placed, and we have a reasonable exposure to almost all of these constituents. So we're taking a somewhat diversified bet even within that space. But by and large, I think there are some where probably the regulatory risk is somewhat lesser. Regulatory risk probably in terms of pricing related risks or a few of the other things are perhaps a little better compared to some of the others. So to that extent, we've kind of, we've calibrated our exposures within that space. But I would like to think that obviously equity markets, we understand better versus commodity markets. So that's, have a better handle, and everything around the equity markets therefore looks good. But much of the play actually is around equity markets that's available in the market today. I think some of these
which space is risk lower? Which space is risk lower within that's
the equity space? I mean, the equity space, the risk is lower, I would say. Plus, in some of the equity sub-segments, the competition is also limited. We are dealing with a 2-player market, a 3-player market.
Okay.
versus some of the others where maybe there are 30 players. So you probably then have a somewhat better positioning out there.
All right, Tahir, we'll let you go on that note. Thanks a lot for joining us. Appreciate your thoughts here. And if we don't meet again, Happy New Year to you and your entire team at
Happy New Year
Invesco.
to you guys as well at CNBC-TV.
All right, thanks for that. Well, let's get some corporate action going. Remember, we were just talking to Tahir about the IT space. Coforge is the company on our radar. The company has given a 13 to 16% constant currency revenue growth guidance for FY24. To discuss how confident they are about achieving this and how is the demand environment, we have Sudhir Singh, the Chief Executive Officer at Coforge, who joins us now. Mr. Singh, always great speaking to you. Thank you for joining us on the channel. You know, most companies in your space are guiding for higher amount of furloughs in Q3 and Q4. How is the demand situation at your end?
Well, the demand for the industry for the last 5 quarters has been tough. At our end, we believe that the demand situation currently will allow us to deliver on the growth guidance that we gave for the year at the beginning of the year. You talked about a 13 to 16% growth guidance that we gave at the beginning of the year. Given the macros as they exist right now and given the specific deal pipeline that we have, we believe we will deliver within that range. And in a year like this, I think all of us recognize that that's going to be a pretty remarkable achievement.
Right. Hi, Sudhir. Good morning. Nigel on this side. Always good to see you in. Well, between 13 to 16%, will it be at the upper end? As of now, what is it looking at? At the upper end or the low end? And also, if you could tell us scope for improvement on the margin parameter, do we get to 20%?
So, Nigel, we are very confident around the fact that even in Q3, which is a seasonally weak quarter, margins should see a significant upside. Q2, our margins went up by 160 bips over Q1. Q3 should again see a very strong improvement in the margins. Q3 is normally a seasonally weak quarter, so we do expect growth, but Q3 is going to be like every other Q3, a tepid growth quarter. That's how we see Q3. Q4 should see a rebound given the deal pipeline and the deals that have already been locked in, and that's what's going to get us to the 13 to 16% range.
But where? To the upper end or the lower end?
We'll talk about that in the investor call, but definitely within the range.
Okay, within the range. Sudhir, hi, morning. Prashant here. You know, HCL Tech recently flagged off one of its clients going the captive route for their BPO operations. We all have been talking about for the last year or so the rise of global captive centers here in India. This insourcing, is that emerging as a bit of a risk at the margin or has always been there? How do you look at it?
We haven't encountered it across our client portfolio so far. We've seen the same reports that you refer to right now, but GCC setups have had a bit of a seasonality around them. Currently, there does seem to be more action on that front, but at Coforge, across the client set and the prospect set that we're looking at, we haven't seen revenue around the margins getting impacted because of those developments at all.
Okay, fine. You know, I just want to understand a little more about the deal wins as well, Sudhir. You've seen 7 consecutive quarters of $300 million plus deal wins, right? How is the deal velocity right now? Do you think this is a level that you can maintain over the next couple of quarters, or can you even build on to this?
Over the last 7 quarters, the last 5 have been particularly tough on the demand environment front for the industry, and yet the point that you made, we've sustained a strong order intake. We do believe that order intake level, that threshold of 300 plus or minus a few tens of millions of dollars, is a number that we should be able to sustain. And I say that largely based off the back of the deals that we are already pursuing. We talked earlier also about the fact that the order executable number that we talk about every quarter, which is the signed order book for the next 12 months over the last 6.5 years, has had a very strong congruence to the revenue that we realized in the subsequent 12 months. We believe that trend will stay and the deal velocity is likely to be in the same benchmark that it has been now for the last 7 quarters.
All right. Sudhir, what's the opportunity you're seeing in AI? You know, what kind of progress are you all making? And say in the next few years, what kind of contribution you can see coming in from this segment?
Well, AI at this point in time, the conversation seems to have moved. I mean, around March, if we have this conversation, the conversation is more around, is AI going to be a new tech set that is going to take revenue away? I think that conversation is behind us. We have a lot of very active conversations. Our own AI platform, Bazaar, is up and running. We've already created 3 different modules, a cognitive AI module, a Gen AI module, and on the 11th, we're going to announce a responsible AI module that's coming in. Conversations continue to be thick, but you're not really at this stage signing AI-only projects. Almost every conversation that we have, almost every proposal that we submit, almost every proactive pitch that we make has, across the service lines that Coforge has to have AI as an integral piece of it. So to that extent, it's become vital. But are we signing AI-only projects that are material? The answer to that still would be no right now.
So that's interesting. So you're saying across all sectors, right? Whether it's BFS, insurance, travel, retail, there is some element of AI that you are using. But as a percentage of your revenues, what kind of contribution do you see from AI, from generative AI over the next couple of years?
Difficult to forecast at this stage. If I look at the state right now, not just the industry sectors that you talked about, across every tech service line, whether that's cloud infrastructure, whether that is next-gen ADM, whether it is data analytics, AI now has become integral to just the service offering that we have. We don't lead into AI or into cloud or a conversation around cloud without talking about the AI-based framework that we've created. So AI alone as a standalone is not a service line that we operate with. We look at AI as being embedded in all the, for lack of a better word, the traditional technology service lines that Coforge has always had. 2 years from now, I would suspect that AI-only projects are likely to start becoming material. At this point in time, almost every piece of work that we sign necessarily has an AI component injected into it right now.
You know, Sudhir, we had somebody from MIT Media Labs over talking to a bunch of us, and he's a professor there, and you know, they obviously see a lot of stuff happening in AI, etc. The conversation was around AI. They see a lot of stuff, out there before it comes to the market, etc. He said the next 5 years, the pace of change is suddenly going to jump at us at an unprecedented scale. So it's kind of at a takeoff moment, and suddenly it'll overtake us in very, very significant way. Do you feel that is true, or people in the field sometimes tend to overemphasize the very near term? What's your view, briefly?
I don't think there's any doubt around the fact that it's going to be one of the most powerful technologies that all of us have encountered ever. And that's a given. The question is, to what extent does AI as a standalone for IT service players like us become a revenue stream? My submission to you would be, it's going to be all pervasive. It is going to change every tech service line that IT service players have. It's not going to be a standalone entity where you just go out there and start selling AI-only projects at scale anytime soon. But everything that we're doing right now, everything that we're likely to be doing a year or 2 years down the line is going to be massively influenced by AI. No one's going to win, no one's going to survive, at least in our industry, unless we've trained our folks, unless we've built the right alliances, unless we have alliances with places like the University of Pennsylvania or the MIT Media Labs, to your point that we already have standing.
Well, that's a very important point, actually. You have to keep up with the new technology, or else you'll fall way behind. But any indication of 2024 budgeting spends? Do you think it's going to be less than what we saw last year? Any signs?
I don't think under any circumstance it's likely to be lesser than what we've seen in the current fiscal. At this point in time, at least for most of the banks, most of the insurance carriers, even most of the travel majors, we do have a sense across the client base in terms of what the budgets next year are likely to be. The good news is it's not going to be any worse or any lower than where it was next year. I believe the jury is still out around whether it's going to be materially higher. There's nothing that we've seen so far that convinces us that there's going to be a significant turnaround and a very significant spike from the levels that we are at. The level where we are at, we believe, is going to be the base demand level going forward. The next quarter or two, that level is not likely to change, at least given the conversations that we've had. So there are, for lack of a better word, there continue to be headwinds, but they aren't getting strengthened on the revenue side. On margins, there are clear tailwinds, because with attrition numbers having gone down, I think the flex that we as industry participants have around increasing margins is improving. But revenue numbers, the demand macros are likely to stay where they are for now.
All right.
All right, so we'll leave it there. Interesting conversation, and I hope you come back with a slightly more deeper dive into this, the AI business, and how, as you said, you so well put it, it's going to change everything in terms of how IT services companies offer and kind of do work for their clients over the next couple of years. Thanks very much for joining us. 73 points higher. We're at 20,975. So there's about 25 points away. We're basically higher than day before yesterday's level, the high point, and about 25 points from the 21,000 number. So very, very close by. Orchid Pharma is jumping about 15% or so. And I think there is an initiation report which has come through from Investec. Ekta is standing by with that. Ekta, morning.
Well, yes, Orchid Pharma has jumped higher in today's trading session. Investec has initiated with a buy and a target price of 800 odd rupees. They believe that they are building a CEF, which is cephalosporin. It's a type of drug, future and more. So they are set for growth, strong growth over the next 3 years, according to Investec. The new management, remember, Dhanuka's promoters have taken over Orchid Pharma. They continue to execute a turnaround strategy plus leverage their core strengths. So, for example, over the past 3 years, the management, one, has tripled the EBITDA and two, deleveraged the balance sheet. They forecast a 35% EBITDA CAGR for FY23 to FY26, which is making Investec bullish on the stock.
Thanks a lot for that, Ekta. Well, let's do one thing. Let us take a quick commercial break. But on the other side, we'll go full tilt on what to expect from the RBI policy. A whole host of guests are joining in to tell us what they're expecting from the much-awaited RBI Governor address later today. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence.
Co-presented by